Well, hello, everyone. Bonjour tout le monde. Welcome to the Building Financial Resilience in Uncertain Times webinar, where our partners with Leith Wheeler Investment Counsel will explore how community foundations can protect their assets through times of economic uncertainty. For those of you that have not met, my name is Tracy Albert, Director of Network Engagement for Community Foundations of Canada. It is absolutely a pleasure to see each of you here with us today. Please feel free to introduce yourself in the chat. This is your time to also connect with your peers, that we have peers from coast to coast to coast. We are set to gather from 1 p.m. to 2:20 p.m. Eastern Time today. I'm coming to you from Calgary, Alberta, Treaty 7 territory on the traditional lands of the Blackfoot Confederacy, the Tsuut'ina, the Stoney Nakoda Nation, and Métis Nation. I am grateful to work, live, and learn on the traditional territory of Treaty 7, and I'm continuing to learn more about how I can be a better friend to the Indigenous communities. I'm on a personal journey of building my knowledge and strengthening my respect, and come with an openness to learn and understand the truth. I am committed to honor the past, be aware of the present, and to build an inclusive and caring future of peace, friendship, and of understanding. Again, welcome. And before we dive into today's session, I'd like to just go over a few housekeeping details. This session is being recorded, and a copy will be posted in the resource library in the coming days, and a copy will be emailed to you following today's session. And just a friendly Zoom reminder, we are in meeting mode today, and we can see and hear you, and you can see and hear us as a conversation between each other as we would in any meeting style. So please do use the mute button during our presentation, as this assists for all to have the best experience. And if you have questions throughout the session, please pop them into the chat box. We will be incorporating and collecting all of your questions for a short Q&A at the end. And for the best user experience, please also use speaker view on Zoom and to turn up your computer's volume. This session is available in both English and French. And to access the French and English interpretation, you'll see a globe at the bottom of your screen. And if you click on that globe, you can switch between French and English. We're also sharing a copy of the French slides in the chat at this time. Well, today we are joined by two members from Leith Wheeler, Mike Baker and Dallas Sees. Leith Wheeler is an independent investment firm that offers individual and institutional investment products and services. Mike Baker is Vice President with the Private Client Portfolio Management Branch at Leith Wheeler. And Mike brings over 20 years of experience managing assets for individuals as well as for nonprofit clients. He holds the Chartered Financial Analysis designation and is a member of CFA Society Toronto. With his combination of technical education and experience, Mike is uniquely able to help both foundations and families successfully transition their wealth and stewardship to the next generation. And Dallas is joining us from the Calgary area as well. And Dallas is a portfolio manager with Leith Wheeler and is responsible for the discretionary investment management of private clients, and charitable foundation portfolios. Dallas brings many years of experience working with the Scotiabank and holds the Chartered Investment Manager designation. Dallas is passionate about helping to simplify the complexities of the investment world and aligning portfolios with her clients' specific goals. And I share with each of you, Mike and Dallas are dear friends to each of us, and we've brought our tea as we plan to move through today's webinar. And so now, Dallas and Mike, thank you so much for sharing this time with us today. Thank you for offering your wisdom, and I'm very excited now to turn the screen over to you. Welcome.
Great. Thank you, Tracy, and welcome everyone.
Thank you so much.
Hopefully everyone can see that okay. Just switching presenters here. Great. So thanks so much, everyone. Pleasure to be here today. My name is Dallas Seitz, as Tracy mentioned, and I'm one of the portfolio managers based here in our Calgary office. I cover private client and foundation portfolios throughout Western Canada, and I'm joined today by my teammate, Mike Baker, who's normally based out of our Toronto office, but joining us today from his hotel room in Ottawa.
Hi, everybody.
Great. So we'll move straight into the presentation here, but first there's a quick message from our legal team. Please just make sure to understand that everything we're going to talk about here today is very general in nature. The investment world requires an in-depth conversation at all times with your specific investment managers. So please speak directly to them regarding any specific guidance or advice after the presentation today, or we are, of course, always happy to answer any questions that may arise. So building resilience in uncertain times. We were talking just before the presentation today about how this is such a timely topic. It was phrased really well in the outline to this presentation that community foundations have been a part of the fabric of our society for over 100 years. And in order to continue that impact for the next 100 years, they need to be continually adapting and building financial resilience. And so I'm going to be giving away the ending a little bit here before we even get started, but resilience is not actually built during difficult times. It starts long before any of these storm clouds approach. Later in the presentation, Mike is going to talk a little bit about the several ways that we define risk as investment managers and how it can be unique depending on your community circumstances. But there's no doubt that one of the biggest risks many of you likely face is not being able to meet the obligations of the communities that you serve. If you wait until the depths of any economic crisis to plan, you may not actually be in a strong position to provide for the communities that you serve. So given what the world's been through over the last 2 to 3 years, there's certainly been no shortage of a need for resilience in a multitude of ways. No matter the size, every one of your organizations is ultimately a mosaic of individual histories, experiences, goals, dreams, and visions for the future of your people. So community foundations are a wonderful example of this, collective of individuals that are focused on helping to build resilient and therefore strong communities. In a past study, Dr. Sharon Daines found that there were 5 key characteristics that contribute to personal resiliency. So they're being positive. Do you make lemons out of lemonade? It's being focused on those goals for the future, being flexible, open to new opportunities as they arise, dealing with uncertainty. You want to be organized and you want to be proactive. So at Leith Wheeler, we often liken this to what we call preparation over prediction, and it's ingrained in our daily work. So whether we're speaking about individual finances, a small business, community foundations, or large institutions, the lesson is often the same, that the longer you wait to start to build that strong foundation, pun intended in this case, the less likely you are to be resilient to whatever the world economy will throw at you. So just as the characteristics on the last page contributed to personal resilience, financial resources are one of the more significant contributors to overall financial resilience. So throughout this presentation today, we've tried to highlight some of the tried and true strategies for building financial resources, and then ultimately long-term resilience for your respective community foundations. On the left side here, I've highlighted a few key financial resources and then paired them with just some ideas that any community foundation may want to consider. Some of these fall directly into our mandate alongside you as investment managers. Others certainly lean more heavily into the work that you do every day in your communities. But together between the two, they weave a pretty strong fabric across a variety of segments for the foundation. So we'll talk about many of these in the presentation today, but generally, there's 5 categories to consider. So you want to have an overall plan and that core mission at the forefront of everything that you do. You want to have a strong asset base and prudent portfolio management. You need to have a firm grasp on the long-term nature of the funds in question. We always want to have a contingency plan in place in the form of a reserve fund and be realistic about different time horizons for cash flow planning. Income stability is a significant asset. So perhaps this comes in the form of diversified sources of revenue and earned income. And then maybe one of the most overlooked difference makers is your overall human capital. So specifically from a financial resilience point of view, this might be continuous education, strong staffing metrics, or maybe it's governance related and focused on that prudent protection of the foundation's assets. So here's a chart with a lot going on. But as I already mentioned, our ultimate aim is always to move forward prepared for whatever the world can throw at us. And this busy chart highlights how some of the stuff the world can throw at us can seem endless at times. The line here spans only 15 years. So since the later stages of the global financial crisis, and helps illustrate just how many what we call reasons to sell the global economy and the markets will provide over time. Looking backwards, even only 15 years, many are probably hard to remember now, but in their time, they were the headlines of the moment and they served to create fear that this time was different or the markets would never recover. So, for example, in the early stages on the chart here, you had large financial firms and car manufacturers filing for bankruptcy in 2009, 2008. We had the first US government shutdown. 2 years later, the Dow fell 1,000 points for the first time ever. And then we can fast forward into more of the COVID bear market and the terrible headlines that ensued there when the global economy was essentially shuttered. More recently, it's become the war in Ukraine, inflation headlines, and that ugly R word, the upcoming recession. So none of this is intended to say that these events aren't important in their time. When you're in the moment, they're as real as it gets, and it would be completely normal to feel some anxiety over any one of these events, and normal to get caught up in the present, believe it's here to stay, and ultimately, however, time marches on towards the next big headline. So on my next slide, I'm going to take this time horizon out just a little bit farther and look deeper at what normal in the equity markets looks like. But before we do, let's put up a quick quiz just to make sure I haven't put you to sleep already. And I think that'll show up here in a moment. So the S&P 500 is an index that tracks the 500 largest companies in the US stock markets. And we use the US because there's lots of data, big economy, lots to work with here. So what do you think is the average intra-year decline or fall from highest to lowest in a 1-year time frame for the S&P 500 index? And we'll give you just a couple of minutes to input your answers there. And now I'm realizing I don't actually know if I will be able to see the poll results.
Apologies, I think we're having just a bit of a technical difficulties. It's saying it's launched our end. But I'm wondering from a participant side if you can see the poll.
We have just some thumbs up, if you can see, just using the thumbs on the reaction. Aronson, he sees it. Fabulous. And it's been shown twice. Beautiful. Thank you so much. I appreciate you letting us know.
And I don't know if anyone on the CFC side might be able to just read me. Oh, there we go. Okay, thank you. I can see it. Okay, so we've got most of the answers coming in here at the negative 7.75%. So always interesting to see. The answer is actually C for the S&P 500. The average intra-year decline is 14%. So I'm gonna move on to the next slide here and show you a little bit more data with regards to that. Okay, so let's look closer at where that negative 14% number comes from. So what you see here in gray, all of these little gray bars at the top here, these are the calendar returns for every year of those top 500 stocks in the US markets. And this goes from 1980 to 2021. I do like to point out that these numbers are based on price only as well, and they don't include any of the dividends or income that the stocks pay out to shareholders. So these numbers are positive through this time frame in 32 of the 42 years, which is 76% of the time. These red dots that underneath here, those represent the largest top to bottom drop that the market did during that specific year. And this is what works out to an average of 14% through this time period. So you can see, for example, in a year like 1987, you had markets returning a total of 2% in that year, but at some point in time through the year, they actually dropped a total of 34. Or over here where you were up 34%, but at some point through the year, it dropped down 3. So as hard as it can feel to be in the midst of one of these drops, it might have been surprising to learn that 14% is normal every year. Despite those annual drops, the average return is 9.4% per year. And this included the 2000 to 2010 period, which some people refer to as the lost decade for US stocks after the tech bubble burst in the early 2000s. So the takeaway is that once every so often the world breaks, something goes wrong, and there's very few ways to predict with real certainty how the markets are going to react. So the longer the time horizon, the less it matters. And the time horizon of a foundation is, of course, infinitely longer than that of even an individual investor. So where are we today? And there's, you're not supposed to really be able to read the specifics of these slides, but what's here on the top left-hand corner is what we call the Consumer Sentiment Index. So with COVID lockdowns, the current crisis in Ukraine, the strain on healthcare, mental health crisis, there's a lot going on in the last few years in the world. And what this chart is showing is that sentiment levels have actually hit the lowest levels since they began tracking this data. And this is even worse than what we saw in the financial crisis when, as I mentioned, large banks were going under in the United States. So we're incredibly pessimistic. And one of the things that's hard to read from these charts, but I want to point out, is that often when stocks and pessimism is this negative, the forward-looking returns are actually quite strong. So for example, in May of 1980, which is back here, the 12-month forward return for the S&P 500 was 20%. Through the financial crisis, it was 22%. So all a couple of examples of how, right now that doesn't help it make it feel any less sticky, but it's a good example of how markets cycle through. So with all of these cycles, we often get asked, why didn't we predict the crash? Or why didn't we move assets to safety in advance of this negative market catalyst? Most recently, we're fielding a lot of questions about the recession, that dreaded R word that I mentioned earlier. And as the likelihood of a recession grows, you might be wondering, does your portfolio strategy need to pivot, or does it need to sit on the sidelines? And these numbers are intended to show just how difficult it is to predict. So in any 6-month time frame leading up to a recession, you can see that it's a bit of a mixed bag of returns. And the same goes for market returns through any of the historic sessions in this time frame post-World War II. So what's not a mixed bag, however, is that the stock market tends to do very well post-recession, with average 3-year returns of 48%, average 5-year returns of 93%, and average 10-year returns of 256%. So despite the average correction being negative 31%, this year the S&P 500 is down almost 25 or close to 25. So we don't know exactly where we are in the cycle, but once again, the theme is the same. Long-term performance eventually washes through the noise of those short-term pullbacks, even the incredibly substantial ones. So it's not about predicting, but about building that solid, diversified portfolio to come out the other side. And lastly, before we pass it over to Mike here, as a bit of an interesting data point on the pitfalls of trying to time the markets, I wanted to share a recent study which looked at 7 of the most used valuation metrics and measured their accuracy in predicting the most recent 21 major market declines. So beyond the scope of this presentation to know the nitty-gritty of each of those metrics, but when they did this study, none of the indicators consistently predicted major market declines. None of them appeared reliable enough to serve as a basis for decision-making. And most, on average, signaled overvaluation, meaning stocks were too high, you should sell, 10 to 30 months prior to the peak. So the number one indicator in this study was the Buffett indicator. And again, I won't get into the details of what that is, but it was only accurate 57% of the time. So you're basically as good as flipping a coin. And on top of this, the last time this indicator flashed sell or overvalued time to get out was September 2016. So if we as portfolio managers had gone, this is our trigger to move our clients to the sidelines now, yes, we would have missed the pain of 4 different corrections of 10% or more, but we would have at the same time missed out on an annualized return of 10.17% per year. And to put that into context, if you have $1 million and you invest that at 10.17% over that 6-year time frame, you've missed out on $788,000 worth of growth. So you haven't quite doubled your portfolio, but it's getting up there. So the takeaway is prepare, don't predict. And the remainder of the presentation is going to center around kind of key ways to protect assets through times of economic uncertainty and recession. And these are have a plan, prepare for that what if, have a reserve fund, diversify, think long-term, and stay invested. Focus on what you can control. I'm going to pass over to Mike now.
Thanks, Dallas. And I'd just like to take a moment to acknowledge that we live, work, and play on the traditional lands of Indigenous peoples. The city of Ottawa honors the peoples and land of the Anishinaabe Algonquin Nation. And we want to express our gratitude for this ongoing privilege and acknowledge our responsibility as a firm and as individuals to further efforts towards reconciliation. And I'm also, on behalf of the firm, we're honored to be in our 4th year as a National Vital Signs Partner with Community Foundations of Canada. So let's talk a little bit about having a plan. So Dallas, if you could forward to the next slide. So why is an investment policy important? So an investment policy statement, otherwise known as an IPS, Some organizations call it a statement of investment policies and procedures, which is a SIP, an SIPP. You may have heard those terms used interchangeably. And when we're talking about this, it's the same thing. So as Dallas said before, with showing those results of the S&P 500 on the bar chart, with any investment portfolio, you have to assume that at some point markets will stumble, and from time to time it will feel like they're breaking. This is normal. This is part of the cycle of long-term growth. Now, a crisis is typically the time that organizations either A, realize that they don't have a thorough enough plan in place, or B, they realize they need to dust off the plan they have and actually adhere to it. I would suggest that we not wait until we're in the middle of it before realizing that the plan isn't adequate. So every investment policy will be different based on the unique needs and circumstances of the organization in question. But the following list will provide a good starting point for what should be included in a comprehensive plan. And it's the document that lays out the purpose of the funds in question. It's like the roadmap or the business plan, if you will. And generally, it will state the purpose of the document, the mission of the organization. It will define and delegate the roles of various stakeholders, from the board to the investment committee to various service providers. It'll lay out the goals and objectives for the fund and discuss how those objectives are going to become a reality. It defines the risk profile of the organization and spells out the performance and risk expectations and targets, and we'll talk a little bit more about risk in a few minutes. It defines any spending or liquidity needs and constraints and puts guidelines in place for liquidity events. It lists the policy portfolio or those asset allocation targets for each asset class or investment style in order to achieve the objectives of the organization. It discusses rebalancing policies and procedures, the how and the when of when to buy, when to sell, how to rebalance between various asset classes. And it determines when investment performance will be reviewed, and it spells out how the fund manager will be evaluated. Sometimes we've seen policy will be even broader than this and include policies on gifting, receiving of securities in kind and how those are dealt with. So those are all also very important parts of that policy. Now, it's important that the investment policy get reviewed on occasion as well. So say once a year would be good governance. And the point of reviewing the policy on a periodic basis isn't to continually make changes to an investment program and portfolio, which would defeat the purpose. You should only make changes when necessary. And if any of these key criteria on this slide have changed, so the objectives, the time horizon, the risk tolerance, or the income or liquidity requirements of the foundation, and not because markets make you feel nervous, because as Dallas showed on that slide, the reasons to sell, there's always going to be a reason to feel nervous. And if you're not feeling nervous, maybe you should. The point of reviewing the IPS is to remind everyone involved why you're investing in the first place. If the document is set up correctly, going over it on an annual basis is a great way to remind all parties involved what the original goals were. It can be a conversation starter or a conversation ender, depending on the discussion around the investment committee table. So an investment policy can also act as something of a benchmark to measure whether your investment program is successful or not. And just there's a lot of information on this slide and a lot of governance and updating that happens with investment policies over time. So it's worth pointing out that a committee doesn't need to come up with an investment policy themselves. An experienced portfolio manager should be able to guide these conversations for either drafting a new policy or bringing an existing one up to speed with current best practices. So always know that you're not alone in this. So I think from here, we're going to jump into a breakout room briefly. So for the breakout room, here's the question that we're thinking about. So in general, how prepared do you think your foundation is for the current market drawdown in both stocks and bonds or fixed income? Has the IPS been consulted? Were any adjustments made?
So we've just
So I
put
think-
questions in the chat for you there. And if people can join a breakout room, you should see the options on your screen there. Please don't join a breakout room that has more than 6 people. If you are francophone, si tu parles français, vous pouvez rejoindre à la salle de discussion francophone et c'est décrit sur le titre de la salle. If you are wondering where to find breakout rooms and you're not seeing it on your screen, you can click on more and the 3 dots and you should see breakout rooms there and you should see a
we watch people reappear. Christine, a copy of the webinar will be emailed to you as well for that initial onset area that you, yeah.
Okay, welcome back, everyone. I'll maybe just give a minute here for the breakout rooms to empty.
Dallas, I think we have everyone back. Over
Okay.
to you again. Thank you.
Perfect. So I'm going to move on now to speaking about the importance of planning for that rainy day. So blending a solid reserve or emergency fund with proper cash flow planning is critical to the well-being of any investor. And we love this quote by Morgan Housel, which is a good time to remember that the most important part of a plan is planning on your plan not going according to plan. And so the importance of this reserve fund is essentially, or we could call it your safety net bucket. This is essentially to ensure that all of those what ifs that we've seen that the market can throw at us in any short-term period of time do not derail the planning of your foundation and do not derail your ability to provide for the needs of your community foundation. And so the specifics of how much exactly should be in this reserve fund or this emergency bucket are really up to the individual needs of your foundation. Some things that could contribute to the size of your reserve fund might be the size of your community foundation in general, the asset base that you have. The more significant the asset base, the risk looks a little bit different under that scenario. Do you have a lot of short-term cash flow requirements? What does your disbursements look like over the next couple of years? But essentially, this reserve fund is intended to be that safety net where short-term market movement is not going to throw your plan off track. Okay. And so one other thing that I'll just add there is that even for individual investors, there's a lot of data showing how important this safety net or this rainy day fund can be to the long-term stability of your wealth. And it significantly reduces the likelihood of true capital destruction caused by emotional market timing, or unexpected drawdowns during periods of poor market performance, it erases the need for those surprises to throw you off track in general, or the likelihood of that. And so what we find for many of our institutional clients is that generally there's two main buckets, and I call these protect and sustain. So in the short term, that reserve fund that I just mentioned, or that emergency bucket, and then there's the longer term endowment portfolio. Now, you might also have a couple of extra buckets or a third bucket if there's some sort of a specific project or cause that you've done some specific fundraising for. But the key ultimately is matching the types of securities inside of these individual buckets with the time horizons and their respective cash flow needs. So from a projected return point of view, short-term capital should really be focused on preservation. It should be invested with low volatility. You want it to provide stable and consistent income. Longer-term funds, on the other hand, may seek more growth. This may be focused on keeping up with inflation. And for example, maybe you need to seek out a benchmark of inflation plus 2 to 3%. Anything over 5 years can and arguably should potentially account for a disciplined amount of equity exposure within the portfolio. As I mentioned before, those shorter term funds from a liquidity standpoint, which means how quickly can we access our capital if we need it? That's the definition of liquidity on our side. Shorter term funds should be highly liquid, and the longer term funds should maintain reasonable liquidity to account for any forecasted disbursement requirements. And from a governance perspective, you want to be really careful of any assets that do offer lower liquidity. There's often a reason for lockups and things like that. So you want to make sure that the size of your assets merits that sort of allocation. From a risk tolerance perspective, reserve funds are typically allocated towards cash equivalent instruments. So cash, GICs, very short-term fixed income or bonds. And then those longer-term assets, as I mentioned before, are looking for an agreed upon level of return. So you want to maximize that return for an agreed upon level of short-term downside risk. As we saw in the opening, there's no such thing as a free lunch in the equity markets. So you do need to be prepared for this side of the portfolio to experience volatility like we're seeing now. And the specific asset class weights in your respective buckets, that's highly specialized and should be a discussion with your respective investment manager. But remember to focus on the big picture. So you want to balance the needs of today with those of the future to determine that sustainable payout ratio for your specific portfolio. And you may want to consider developing spending policies that are based on rolling averages. So you may want to be using a 3-year rolling average for things like performance or inflation when you're talking about disbursements or other cash flow needs. And now I will pass it over to Mike to talk about the importance of further diversifying that long-term piece of the portfolio to protect the capital for generations to follow.
Okay, thanks, Dallas. I'm just mindful of time here. So before talking about diversification, I just want to spend a minute or so on risk. So if we can go to the next slide. So there are many, many ways to define risk. And as investment managers, we throw the word risk around willy-nilly all the time. So what is it? It's different things to different people and different organizations. And one person's view about risk may be another person's opportunity. So there's about a dozen bullets or so on this slide outlining some of the main ones as it relates to investing foundation assets. But the biggest risk is the one Dallas mentioned earlier, which is not being able to meet the foundation's financial commitments and obligations to their community. But it's important also to know that investing foundation assets is not about avoiding risk. It's actually more about understanding what risks are out there and which ones are the biggest priorities to be managed. They can't be avoided. but they can be identified and you can put a plan in place to manage them within your investment policy. And one thing that we were speaking about in our breakout room is also having the ability to communicate with your stakeholders about what those risks are and how they're being managed and addressed thoughtfully, not avoiding them. So if we go to the next slide, the plan to manage risks comes in the form of diversification, as you all know, which is simply investing in a variety of different types of assets whose return comes in different ways. Some assets zig while other assets zag at specific points in time. So for example, if I were to ask, what is the least risky investment? I'm sure many people thinking about the potential for negative returns as risk might say government bonds. After all, they're guaranteed, right? Well, technically, yes. And that's this top line on this chart. However, their prices are impacted by the movement in interest rates in the broad economy, and those prices are impacted in the short run. And those prices are impacted differently than stocks. So looking at this table, 100% fixed income portfolio for the 63 years ending 2021, the worst return on record was -4%, which is circled there. As interest rates increased, now that's until this year, there's some pretty ugly returns from bonds this year, which will be setting new records. However, knowing that stocks have generally tended, or stocks or equities, same thing, have generally tended to behave differently, you can see on the next line that replacing 20% of that bond allocation with stocks has not only decreased the worst potential drawdown, but it's also increased the upside, so the historical return, which is the first column on the left, from 7.1 to 8. So this is the benefit of diversification. While there's no free lunch in owning stocks by themselves, this is the only free lunch you get in investing, is by combining assets to lower volatility. And just one quick note as a reminder about how gains and losses work. If you look at that very bottom line, which nobody would probably invest in a 100% equity portfolio, but the illustration is that 100% equity portfolio, the worst year, is down about 33% over this time horizon. You need a 50% return to recover from that. And so you also need much more time to recover. So a well-diversified approach doesn't need those heroics to navigate its way through business cycle. So if we go on to the next slide, which we've called the tortoise and the hare, this builds on this theme of diversification. So each tile on this slide represents a specific asset class, like large stocks or high yield bonds, and plots them from best returners to worst returners for every year in this 2007 to 2021 period. We also plotted and put little diamonds around this AA portfolio, which is a diversified portfolio of assets. And there are some takeaways here when I look at this. I see that sometimes the worst asset class in one year is the best asset class the next year, and vice versa. And sometimes a winning or losing streak can go on for a few years. I actually take away the randomness of it all and how unpredictable it can really be. And you see that the odds of trying to predict the best in any given year is futile. So we would suggest to our clients that the most important question isn't how can we earn the highest returns? The most important question really is, what are the best returns we can earn for the longest period of time? So in fact, if you're able to be in the top half on a consistent basis for 10 to 15 years, the chances are you end up in the top 10% of results over the entire period. You'll notice that that asset allocation or that AA model is never the best, but it's also never the worst. And it's solidly down the middle, so to speak. And if we were to look at what those compound returns look like, over that entire period, it's a return of just shy of 7%. The worst returning asset class is not even 1% over that full period annualized. The best one was just over 10%, which we would all love, but there's a trade-off. that top one would have had a negative return at some point through the cycle of close to 40%, which would have been all stocks, whereas that asset mix portfolio would have been minus 22. So Dallas will speak a little bit about this later. So in an effort to be the best, many investors actually end up being their own worst enemies by trying to predict rather than plan. And in fact, it's much simpler to manage to avoid big mistakes than to try to be heroes at the end of the day. So it sounds simple, but it's not necessarily easy. If we go to the next slide, it's over to you, Dallas.
Great, thanks, Mike. So we've mentioned the importance of playing the long game a couple of times now. So I'm going to quickly revisit just a few specifics in this area. So from a governance perspective, key to remembering your responsibilities to the long-term viability of your respective foundations. And a common mistake that we see is unnecessary turnover or changes in a portfolio strategy due to adjustments made to the investment committee membership, or even members managing assets as if they had the same time horizon as their own personal assets. And foundations have significantly longer time horizons than individual portfolios. So it's really important to keep this in focus. So manage prudently, but do not manage these assets as if they were your own necessarily. So this chart shows the variability in returns over 1 year and how time can erase a lot of the downside over 5 years and even farther. So what you've got in green here is the upside and the downside for stocks over a 1 year time period. And you've got bonds in blue and a 50-50 mix for simplicity of stocks and bonds. And again, your specific asset mix is going to depend on your individual scenarios. But essentially, as you can see here, time erases a lot of the downside in a well-balanced and diversified portfolio. So it's critical for investment committees to remind all involved of the importance of that long-term thinking and admitting to their limitations. I'll share a great analogy by Charles Ellis, which describes how a successful long-term investor should think much like a tree farmer over time. So he says, if you ran a commercial tree farm, would you ask for up-to-the-minute bulletins on how the forest was growing today? How many people are investing for success just for this year, this month, this week, or this day? And most people and foundations' true time horizons are much longer than they think, 50 years, even more. So we should be investing for success over a lifetime or more than a lifetime, because part of what they're investing will go to their kids, or in your case, your causes after you're gone. So when given enough water, light, air, and space, a tree can grow to great heights as long as you pretty much leave it alone. The same is true of a well-constructed portfolio. It's meant to last for generations and will outlive many, many rounds of new investment committees and executive directors. And on to the next slide here. This uses a relatively recent market example of the importance of then sticking to your long-term plan and your overarching strategic asset mix during market volatility. So the current bear market that we're in is ongoing, and we'll go back and use kind of the next most recent example, which was the COVID bear market of March of 2020. So this is a portfolio of $5 million as of December 31st, 2019. And so no one yet knows what's to come as COVID explodes through the world over the next couple of years. So you've got this $5 million, and the fastest bear market ever occurs in March of 2020. On the left-hand side shows the individual or the group that purely panics. They sell everything on March 31st, 2020, just after kind of the bottoming of the bear market, just couldn't handle it anymore. As of October 31st, 2020, so a couple of quarters beyond the bottom now, that portfolio is worth $4.5 million. Contrast that with the group in the middle, who they only panic slightly. they have a little bit of a capitulation about how much stock or equity or growth exposure they want to have or they feel is appropriate given what's going on. And they revert their portfolio from being 60% equities and 40% bonds to being 40% equities and 60% bonds. Given this real life example of this panic slightly, this portfolio as of October 2020 would have been worth just under 5 million. So not quite back to where you were at the end of December. The group on the right stays disciplined. They know why they're invested the way that they are. They stick to that asset mix, and they actually just slightly rebalance their portfolio back to their strategic weights. So equities come off substantially. You just add a bit more equity or stock back into your portfolio, for example. This portfolio, once the dust has settled on that bear market example, is now sitting ahead of where they were at the end of December. And so that's just one recent example of the importance of sticking to that discipline. And we'll move on now to our final section here with Mike.
Okay, thanks, Dallas. So if we go on to that next slide, please. So we're going to talk a little bit about staying invested, and Dallas has already touched on that. So this is a slide that may be familiar to some people. I know the messaging likely will be. And remember, before I said sometimes in an effort to be the best, many investors end up being their own worst enemies by trying to predict rather than having a plan. This slide shows how average investors, in an attempt to try to react on the fly, and typically that's based on emotion, they make switches at the wrong time. So what it's showing on this orange box is the average investor has performed over the last almost 20 years at a rate of about 3.6%. And this is research that was done by a firm called Dalbar. A 60-40 portfolio, which we described earlier, 60% stocks or equities and 40% bonds, is the blue bar, which would have returned about 7.4%. Almost a set it and forget it type approach, rebalancing along the ways when asset classes got a little bit out of whack. So why is that such a huge and dramatic difference? I'll give you a hint, it's selling at the bottom and buying more of the hot thing at the top. We're trying to chase performance. So if we look at the next slide, it's about this effort of trying to avoid the worst days or trying to get too predictive. So what this slide shows you, and you have to squint a little bit here because there's green vertical lines and red vertical lines underneath the S&P 500 line graph here. And what it's saying is that the very best days in the stock market, the days that the market goes up the most, are normally clustered around the very worst days. It's easy though, because investors, having been beaten up by the markets, by the news flow, by their own psychology and wanting to stop the pain, they sell at the worst possible times. And there's many, many great sounding reasons. We know what they are. But it's basically that somehow the market is broken and it's different this time. And we know this happens every so often. We spoke about it before, how you have to be prepared and have the ability to persevere through the market breaking so often, which is why you have the plan. Here's some real data. Over the last 25 years, the S&P on average has compounded about 7.5% return in US dollars. That's in 25 years, there are over 6,000 trading days. If an investor had just sold at the wrong time and by dumb luck missed the best 5 days out of over 6,000, then the return drops from 7.5% to 5.5%. If they missed the best 20 days, the return is less than 2%. So you have to be able to persevere through those negative periods. And what I think that the best example that we hear from time to time when people are selling is because they just want to wait for things to settle down. And I would actually say what they're truly saying is they're waiting for things to settle up, because almost nobody goes back in and buys, having sold out near the lows. Over to you, Dallas.
Great. Thanks, Mike. So that wraps up the presentation for today. And hopefully we've helped put some of the recent market volatility into perspective, give you a few tools to safeguard those assets and build resilient long-term focused portfolios. So take note of those key drivers of financial resilience, and try to think about ways that you can utilize these steps to engage with fellow committee members. Remember that without that investment policy statement at the core of everything that you're doing, this is kind of the equivalent of setting off on a flight without your manuals or your safety checks or your radar. You really have no way of telling if you veered off track for the long term. And remember to use the help that you have available to you as institutional clients. So often community foundations are surprised to learn that their endowment size qualifies them for preferential fees, institution level reporting, advice, service from some of Canada's most experienced investment managers. So take the time to learn about your options and take advantage of the experience of portfolio managers who work with clients and foundations like yourselves every day. So when times get tough, go back to basics, revisit that plan, and regularly cycle back to that long-term focus. So in the interest of time, I think we're going to just kind of skip over the second breakout room, but do take some time after the presentation to think about any of those takeaways, and feel free to reach out to us if you have any questions. But I think we'll pass it over to Tracy for some of the Q&A.
Thank you so much, Dallas, and to you and Mike both. Thank you for your guidance today and your tremendous calm and very professional in regards to how you've shared opportunities with our foundations. We've got a couple questions that have come in. So Mike, I'm going to start with you first. And the questions that I'm going to pose to you is really starting to get into the technical part. And this came from Gabby, and she's inquiring on what are some of the most comparable industry sector that community foundations should benchmark in respect to targeted returns, and specifically looking at that long-term endowment focus, as we know, into perpetuity and into the future. One of her thoughts are the larger pension fund strategy likely the most comparable? Mike, over to you.
That's a huge question. I would say a couple of things. I think that the benchmarking should be to the community foundation's own objectives. They have their own objectives that they need to be able to meet. They know what their commitments are to their community. So worrying about trying to benchmark against other not-for-profits or pension plans objectives is misleading. I know everybody wants to compare the numbers, but the true objectives are really close to home. The other thing I would say is when you get into the large pension space, they have a lot of options available to them that smaller community foundations don't have in terms of types of investments, the illiquidity that's involved. And they also have a very different stream of liabilities, right? Pension liabilities are about individuals' retirements, and when the bubble of retirements happens, and how those have to be funded and how those have to be paid for and whatnot. But it's not too dissimilar in that an actuary would look at a pension portfolio and say, well, here's where the big liabilities are. Here's when a big amount of cash flow needs to go out, be it in 5 years or 8 years or 12 years, when there's a big bubble of retirees coming along. And they try to match and offset those required cash flows with their investments. And it's not too dissimilar to what Dallas was talking about in setting up a reserve fund for community foundation, for example, knowing what your commitments are over the next couple of years and having that rainy day fund that is there just in case, so that you can fund those required cash flows. And if you don't need to, because your returns in your long-term portfolio have been so great, perfect. You can maybe take the opportunity to carve a little bit more off into the reserve, because at some point you will need it. So I hope that wasn't too long-winded.
Mike, thank you. And again, you brought back the importance of knowing the direction of the foundation and setting the intent directly from where your foundation is versus we all like to see the other numbers. I get many requests from others to say, please share with me what other foundations are doing, but also coming back to what is it the intent of your organization and what are the best for the values and the planning of your foundation. And Dallas, the second question that's come in, I think this also leads into that, into a deeper level too, as well, is really looking at the appropriate asset mix of a foundation. And that we recognize there's public traded instruments, there's quality equity, and looking at possibly some private debt, equity and real estate, etc. Is there a magic formula for the appropriate mix for a community foundation when we start to look at all of those various factors and those various instruments? What are your thoughts on that?
Great. Thanks, Tracy. We're going to sound like a bit of a broken record here, but it's very specific to your individual needs as a foundation. And so you're basically looking at riding this line between being very, very conservative, fully focused on preservation, and this is where you're talking about those cash type equivalent assets, all the way over to the other side of the spectrum, where now you're talking about things like private equity or debt, things like that aren't necessarily as liquid, but potentially offering some larger returns for the portfolios. And so, with all likelihood, any community foundation finds themselves somewhere in the middle of that. Any individual, in a lot of cases, find themselves somewhere in the middle of that. And so it does come back to bucketing those individual needs for the portfolio and how much is appropriate in each of those asset classes. And even within each of those individual asset classes, there's varying levels of risk, right? So there's shorter term government bonds all the way up to high yield, riskier corporate debt. And so this is really a conversation that needs to be had with an individual that knows the ins and outs of your foundation. I will say, be careful about letting current market events drive too many changes in that asset allocation. I use this analogy with my individual clients a lot, but what's going on in the markets shouldn't really be the biggest driver of your strategic asset allocation. It should be based on kind of three core things, which is ability for risk. And this is the financial backing of either an individual or the foundation. How many assets do you have? Is income consistent or not? How stable, or what stable footing are you on? The second one is more of the heartstrings. It's that willingness. It's, what are the terms inside of our investor policy statement? What do our beneficiaries expect, et cetera, in terms of our willingness to take that next level, that next step up in risk, so to speak, for the portfolio. And the last one is return objectives. And so to meet your cash flow needs, to meet those disbursement quotas, what kind of an asset class or equity component makes sense to deliver those kinds of returns realistically? Because we know as investment managers that there's a certain range in the long term that those different asset classes will provide. So that would just be my 2 cents there, is to really make that decision based on the needs of your foundation and not let market recency drive the bus on that.
Dallas, so well said, and so appreciate both you and Mike and the tremendous gift of each of you sharing with our foundations today. You spoke about resilience earlier on at this start of this presentation, and you shared the core themes of resilience and how community foundations have been working so hard in building resilience throughout the pandemic. But your presentation also tied to the attributes of those personal resilience into how we can create resilient organizations deeper into their portfolios. And I thank you so much for taking the time to break down all the different areas around financial resilience. And also you included the key considerations and actionable steps for community foundations, including building a reserve fund, plan for the unexpected. And so it is so much better to plan than to predict or to react to the current market times. We are extremely grateful to you, Dallas, Mike, and the Leith Wheeler team. We have the other Mike Wahlberg that's on with us as well today. Hello to you, Mike. We are so honored and grateful for this partnership that we could come together, share this time together, learn together, but also have the opportunity to get to know each other at a deeper level from coast to coast to coast with our foundations. We're also very appreciative of your ongoing commitment and dedication to vital signs. You also understand the importance of vital signs and what it represents for communities. And so on behalf of all of our listeners that are with us today, and on behalf of all of the beautiful foundations that are working hard coast to coast to coast, we thank you. And a deep appreciation to all of our attendees. Thank you for taking time out of your day today to venture onto this learning journey with us. We are extremely grateful for your dedication to strengthen your community foundation, which in turn strengthens your community. We do have various other events that are posted on our website, and so please do connect on our website page under the events, and you can follow for the upcoming events. And in addition, today's webinar is recorded and will be provided out to each of you in a follow-up email, and will include the link for the fact sheet that was posted within the chat today. And as we leave today, I just, again, share my appreciation and gratitude for this tremendous group and say thank you to all of you. Please stay well, and we look forward to seeing you very soon. All the best, everyone.